Aloha, this is Kurt Nielsen at EMortgage Hawaii, and I wanted to provide you a short video clip and talk about why mortgage rates have been dropping here in Hawaii. And maybe it's now time to shop if you're looking for property in Hawaii. So let's take a look at where the rates are right now. These are the conforming rates, 30-year fixed at 6.375. The government loans like VA, USDA, FHA are all below 6% at 5.875. And then again, we look at ARM loans quite a bit. They have a lower rate, and we believe that since rates are going to probably come down even further over the next 2 or 3 years, that you might want to consider a 7-year or a 5-year ARM, and those are at 6 or below. And if you look at the jumbo rates, this is pretty unusual. They're virtually the same here as the conforming rates. And remember, conforming in Hawaii is 1,209,000. So you still get a pretty large loan on conforming, but the jumbo rates are the same. So, you can go up much higher on jumbo loans and still get the great rates. So that's good for Hawaii real estate buyers. So let's take a look at what's driving this. This is the mortgage-backed securities bond, a 6% bond. And as you can see over the last 90 days, there's been a nice rise in the price of that bond. And with rising prices, that's rates going down. So it's an inverse relationship. So we want to see the prices continue to rise. If you look at a 12-month view of the mortgage-backed securities market, it's been really bumpy. We had the election in November. We had the Trump administration coming in, tariffs, all sorts of things. So it's been a pretty bumpy ride. But we've had a nice rise, and we're not very far off of that 1-year low we saw back in September of 2024. And I think we're going to get there. And that could be another, half a point drop in mortgage interest rates. So let's talk about what might drive that. Well, generally, mortgage rates follow inflation. Inflation's been very sticky. And the biggest component in CPI is the shelter cost. And shelter costs have been pretty high, and we are really hoping to see them come down. So if they come down, if shelter costs come down, we should see an improvement in CPI, and then that should help mortgage rates even further. But the big factor is really not that. It has to do with the Fed's monetary policy. So if you look, normally the U.S. Treasury, the 10-year Treasury, is usually about 1.5% lower than mortgage rates. So, if you have a Treasury at 4%, you should see mortgage rates at 5.5%. But the spread on these yields has been inflated. And that was because of the Fed's monetary policy. They have been very restrictive, and they are shrinking the money supply by letting mortgage-backed securities and treasuries run off their balance sheet. Now, they did slow down, and so we did see a nice improvement from 3.1 down to 2.3. But if we could get back down to 1.75 or 1.5 spread, then we'd be solidly into the 5% range. So that's what we're hoping for. We have Jacksonville Federal Reserve meeting is ending on Friday, so we should get some information about their monetary policy then. And then we have the meeting in September, I think September 17th, where we probably are going to get a rate cut. And so all of this is kind of trending well. It's a good time to get pre-qualified and maybe to start shopping for real estate. So I think that's it. If you have any questions, you can call me at 808-334-6201. Thank you for watching.